Hi everybody, and welcome back to video number 3 in chapter 18. And when we were looking at this last slide, although we completed it, we didn't really explain the meaning of it. So if I were to minimize this, you can look down here and see the uh, speaker notes. And what that was supposed to illustrate was that in this case, we assumed that a new machine increased monthly fixed costs from 24,000 here to 30,000 here. And it decreased variable costs by $10 per unit. So was that a good idea? From $60. So Rydell's break-even point is currently 80,000 because it went up from 70,000 to 80,000. So how would that new machine affect Rydell's break-even point? If Rydell maintained its selling price of $100 per unit, the contribution margin per unit increased to $40, computed by taking the $100 of selling price per unit minus the new variable cost of $60 instead of $70 per unit. With the new machine, the revised contribution margin ratio is now 40%. $40 divided by $100. So Rydell's revised break-even point in dollars is now 75,000. And the new machine would lower the break-even point by 5,000 or 50 units per month. Okay. So now let's look at a little more complex example where we do the break-even point for a multi-product company. And so here, the CBP formulas can be modified for use when a company sells more than one product. The unit contribution margin is replaced with the weighted average contribution margin per unit. The sales mix is the proportion of sales volume for each product. So let's look at a little bit of an example here. This company's making footballs and basketballs, and the selling price, the expensive football, $100. The basketball, even more expensive, is $120. Variable costs and contribution per margin, and sales mix percent, we sell 60% footballs and 40% basketballs. So our weighted average contribution margin per unit is going to be equal to the contribution margin per unit for each product times the sales mix percent for each product. So here we'll take the $30 of contribution margin per unit for football times 60%. And then $35 for basketball contribution margin per unit times 40%. That comes out $32 weighted average contribution margin per unit. Now, my break-even point in units is going to be the fixed costs, which is $48,000, now divided by $32 of the weighted average contribution margin per unit, and that gives me 1,500 units. And so I can take 1,500 times 60%, and that means I will be selling 900 footballs and 600 basketballs for a total of 1,500 units. I multiply them through times their respective contribution margins per unit, and I get my contribution margin of $27,000 for football and $21,000 for basketballs. And of course, it totals $48,000 at break even. Okay. The assumptions in cost, volume, profit are very important to understand. It assumes that all costs can be classified as variable or fixed, and that costs are linear within a relevant range. And I would tell you I was a little skeptical about costs being linear within a relevant range, but in actual practice, they are pretty close. And number three, the units produced are sold. In this case, inventory is constant and sales mix is constant. And we all know any of these can be changed. Okay, so how do we analyze changes in sales using a degree of operating leverage? Well, here, the degree of operating leverage is a measure of the effects of a change in the level of sales on income. So I take my contribution margin and I divide that by income to get the degree of operating leverage. Let's see how that works. Here is our Rydell company with its respective costs and income. And so we take our contribution margin here of $36,000 and divide that by $12,000 of income. And that gives me 3 degrees of operating leverage. Now, the change in income is going to be the degree of leverage times the change in sales. So if I increase my sales by 10%, I'm going to increase my income by 30%. Let's see if it works. Okay. Here I've increased sales by 10%. You can see that it's a relatively small. But here it goes up by 12,000 sales dollars. And that changes the variable cost and contribution margin. Fixed costs remain the same. Our income goes up by $3,600. And that's going to be 30% of $12,000. So if we decrease by 10%, the same thing holds through. It's going to go down by 30%. So 30% again will be $3,600. It will take us down to $8,400. A little tricky when you're first learning this, but I think you'll see how this is very helpful in some situations. Okay. Excel for cost estimation. Excel has intercept and slope functions. You can use those, as we showed earlier, for estimating our costs, total costs. Okay. And our variable costs as well. Okay. Now, here we're going to compute the unit cost and income under both absorption and variable costing. Now, remembering that absorption costing is what is allowed under GAAP here. We cannot use variable costing under GAAP. We can publish internal documents or even external documents if we brand them accordingly. But what we need to do to calculate our income, our GAAP income, is absorption costing. So contribution margin statement or variable costing statement involves variable costing, costs that change in total with changes in production levels. Variable costs include, of course, direct materials, direct labor, and variable overhead. And fixed overhead is excluded from product costs. That's not true with absorption costing. Fixed cost is included in absorption costing. Okay, and here is an example of that. Here we have our direct materials, direct labor, our expected units to be produced, and our variable overhead per unit, and our fixed overhead of $600,000. So under variable or under absorption costing and variable costing, direct materials, direct labor, variable overhead are all the same. However, fixed overhead is not included in variable costing, where absorption costing fixed overhead is. And that fixed overhead was calculated by taking the 600,000 of fixed overhead per year divided by the expected production of 60,000 units, or $10 per unit. Okay, so under absorption costing, $25 per unit goes to production costs, whereas under variable costing, $15 goes to product cost, with a period expense of $600,000. Okay, so in income reporting using absorption costing, we can see that results in $320,000 of income, whereas under variable costing, our contribution margin is $920,000, and we subtract out our fixed expenses here and here, and our income is substantially less at 120,000 units, 200,000 less. All right. All right. So if we convert income under variable costing to income under absorption costing, if the units produced are equal to the units sold, then there will be no difference between variable costing and absorption costing. But if we produce more, we're going to have greater income under variable costing. If we produce less than the units we sell, we'll have less income under variable costing. And that's because the income under absorption costing is the income under variable costing plus the fixed overhead cost in ending inventory minus the fixed overhead cost in beginning inventory. So the income under absorption costing, we could take the $1,040 here. Guess that wasn't part of this one. And we would add ending inventory of 0 minus the $200,000 in beginning inventory. That would give us income under absorption costing here of $840,000, because the units in fixed overhead cost in the beginning inventory was not the same as that which was in ending. Okay, that looks like the end of chapter 18. And when we return, we'll take a look at chapter 19. Until that time, bye for now.